Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Okay, now come to the instruments of credit policy. Yesterday you have covered what is Indian monetary policy, what are the objectives of monetary policy, what are the analytics of monetary policy and operating procedures and procedures. Now the important part from which you will get questions is the instruments of credit policy. Credit policy also means monetary policy. So question will be either instrument of monetary policy or instrument of credit policy. Ready? So here we will discuss first two important ratios. One is called cash reserve ratio and the other will be called statutory liquidity ratio, CRR, SLR. These are the two tools used by the RBI to control the money supply in the economy. Because by increasing these ratios, the bank's ability to lend will reduce. And by reducing these ratios, bank's ability to lend will increase. Okay. So some basic knowledge of CRR and SLR is required. So what is CRR? As you have studied in economics classes also, 12th standard, maybe CPT or foundation, CRR is the amount which the commercial banks have to maintain as cash deposit with the RBI. How it is calculated? It's some proportion of your time and demand deposit will be kept with RBI. Time and demand deposit means saving account, current account, fixed deposit account. Okay. Say for example, your saving account deposit is 1000 crore. Current account is 2000 crore. And fixed deposit is 7000 crore. So total time and demand deposit is called 10,000 crore. This is your liability towards your deposit holders. So to protect their interest, there must be some liquidity in the banking system. Suppose CRR is 4%. So 4% of 10,000, 400 you have to maintain with RBI. You have to maintain this balance, otherwise RBI will penalize you. So this is how the CRR is calculated. First, suppose such questions come in the exam, numerical question. Add your saving account, current account, fixed deposit account, and then multiply by the CRR percentage, which either will be given to you or you have to see what is CRR when you go to the exam, which is normally around 4%. But it keeps changing. It keeps changing. So one day before the exam, you just do a Google search and check what is CRR on that date. Okay. RBI has the power to change the CRR, both up and down. So RBI may increase the CRR if it thinks that there is a large amount of money supply in the economy. And it can decrease the CRR also if it is of the opinion that inflation is in control and the industry needs a monetary boost up. So on this, the institute can test you questions. Suppose there is an inflation. What should be the policy of RBI towards CRR? Increase the CRR. Or suppose there is a deflation. What should be the policy of RBI to get the economy out of recession and deflation? Reduce the CRR. Make more money supply available to the consumer and the business houses. So demand will increase, production will increase, output will increase, employment will increase. So that is called monetary boost. The reduction in CRR will provide more money in the hands of commercial banks, which it will pass it on to the industry. More money in the hands of the industry will boost up the production, consumption and employment. For example, if the bank deposit is 100 rupees, example is printed there, and CRR is 10%, the liquid cash that the bank should have at all time is rupees 10. So this 10 rupees, what they will do, they have to keep it with RBI. They have to keep it with RBI. And the remaining funds, which is rupees 90, can be used for lending and investment purpose. But this is not 90, because then we have one more ratio which is called SLR. So some amount you have to keep in liquid asset with yourself. This is kept with RBI. SLR is kept by the bank with itself. Then the last line is written, current CRR is 4%. And I have written one note for you. My advice, please check it again a day before you go to the exam. Now write 2 more lines there. Write 2 more lines. RBI does not pay any interest on such balances. RBI does not pay any interest on such balances. Okay. And second, non-banking financial institutions, NBFC or NBFI, non-banking financial institutions are outside the purview of this reserve requirement, because this can be questioned for true false. NBFCs are not required to maintain CRR. True. Okay. So this is some extra 2 lines I have added. Now come to SLR. What is SLR? Statutory liquid ratio. This is the amount of money which banks have to keep in its custody at all times in liquid assets. Write this, liquid assets. This is the amount of money which banks have to keep in its custody at all time in liquid assets like cash, gold or prescribed investment. Cash, gold or prescribed investment. Written. So some proportion of your time and demand deposit you have to keep with yourself in highly liquid assets like cash, gold or prescribed investment. Investments are usually the government securities. So this also helps the government to sell the government securities in the name of SLR. SLR is a very powerful tool to control the liquidity in the economy. Because if you increase the SLR, banks' lending power will decrease. If you decrease the SLR, banks' lending power will increase. To encourage industries to boost up their production, SLR may be decreased to put more money in the hands of commercial banks. It's like CRR as far as money supply is concerned. Higher SLR, money supply will reduce. Lower SLR, money supply will increase. But SLR is kept with the bank itself in the liquid assets, which we have mentioned, cash, gold or prescribed investment. CRR is maintained with RBI. An increase in SLR is used as an inflation control measure to control price rise. Right? So if the question in the exam is how SLR can be used to control the inflation, so your answer will be increase the rate of SLR. Because you are a student of final, you should apply intelligence and answer. Maximum SLR rules, how much RBI can increase SLR up to 40%. But that is maximum. What is the in some books it is written 20%. So this you have to check before you go to the exam. Okay. I have mentioned, write down there, check before you go to the exam. Because you are a student at this level, you can't afford to make a mistake. It increases or decreases. Where will you find this? It will be available on RBI website, or you can just quickly search on Google. You can find it out. So right now it is 19.5%. In some places I found yesterday 20% also. Then maintenance of CRR and SLR are part of what is known as the fractional reserve system in the central banking. So underline fractional reserve system. What is fractional reserve system? Banks have to maintain a certain CRR and SLR. Fractional reserves are a part of the wider quantitative monetary policy. Again underline this word, quantitative monetary policy. So in some question you will come across today that CRR is a quantitative monetary policy tool. True or false? True. SLR is a quantitative monetary policy tool. True, because you are increasing or decreasing the rates. Okay. How do you calculate SLR like your CRR? Suppose 20% of time and demand deposit. So first you calculate time and demand deposit, which in our earlier example it was how much? 10,000. So for the same question, your SLR requirement will be 2,000. If it is not, then they have to invest in some liquid assets. Okay. Otherwise RBI can penalize them. This is about SLR. So you can compare SLR and CRR in the exam now. SLR is with the bank itself. CRR is with RBI. Okay. On CRR you don't get interest. But SLR, of course, if you invest in government security, you will get some interest. SLR rate is usually much higher than CRR rate. SLR is not applicable to NBFC. But that I will check again. Next is borrowing facilities, under which we are going to study two things: liquidity adjustment facility and marginal standing facility or margin standing facility. So next page you see two important borrowing facilities which RBI makes available to commercial banks. That means if commercial banks need funds, they can either use liquidity adjustment facility, or they can use marginal standing facility. So what is LAF and what is MSF? Liquidity adjustment facility. This you actually know. This is repo and reverse repo. Under this facility, commercial banks can borrow from RBI. Commercial banks need funds. They can use this facility, go to RBI and borrow money through the discount window against the collateral of securities. You have to submit securities. You have to give securities as collateral, and then RBI will give you the loan. Which are the securities you use? Commercial bank, commercial bill, treasury bill, or other eligible papers. Currently, the RBI provides financial accommodation to commercial bank through repo and reverse repo under LAF. Underline reverse repo and reverse repo. So repo and reverse repo is associated with liquidity adjustment facility. Commercial bank will give the security as collateral, RBI will lend the money. Reverse repo is reverse of repo, which I am going to explain to you now. Just to add one more line there, point number C, add. LAF is conducted at a fixed time. LAF is conducted at a fixed time on a daily basis. On all working days in Mumbai. So where the banks will have to go? Which branch of RBI? Mumbai branch. Okay. On working days excluding Saturdays. Just technical detail. LAF is conducted at a fixed time on a daily basis. So they have a time slot, let's say around 9:30 to 5:30. And then you can approach the Mumbai branch of RBI and you can get funds, but you will not have to go on Saturdays. Saturday chutti, holiday. Not like your articleship where you have to work every day. What is repo? What is repo? Very important, this word repo is actually repurchase option. REP has been derived from this repurchase option. Easy to remember certain terms. Repo. So what is repo? This is definitely a question in the exam, because it comes in the news quite often that RBI has decreased repo rate, increased repo rate. So what they have done? What is the implication? How it is done? Okay. So repo is defined as an instrument through which commercial banks borrow from RBI. First, I will show you a diagram to understand repo, which you can also draw. And then I'll come back to this point number 2 and 3. Suppose this is the bank, commercial bank. And this is right side, RBI. Okay. They have got government securities, but they need funds. So what they will do? They will sell government security to RBI. Okay. So RBI will purchase government security from them. And RBI will give them funds. So right now they'll get the funds, but then the seller will repurchase the security and pays the amount originally received plus the return on the money for the number of days for which the money was used, which is mutually agreed. So later on what will happen? This commercial bank will repurchase the security at the same rate or at a higher rate. at a higher rate. If suppose this is 96 rupees, then maybe this will be 100 rupees. What does that difference of 4 rupee represent? Interest. Is it right? So now you can draw. Repo diagram. Reverse repo, I'll explain later. First complete repo part. On the left side you write commercial bank into bracket seller of security, original holder. Seller sells securities and receive cash. So it got money, but at the same time it has to give its security as collateral to the other party, which is RBI in our example. And then the seller repurchases securities. Seller repurchases securities and pays the amount originally received. And pays the amount originally received plus the return on the money. Plus the return on the money for the number of days. For the number of days for which the bank, for which the money was used. For which the money was used, which is mutually agreed. Which is mutually agreed. Is it right? I hope you have written. Okay, now I'll go back to the point number 2 and 3 again. After you have understood the diagram, it is easy for understanding the paragraphs. So for borrowing funds by selling security with an agreement to repurchase the security on a mutually agreed future date at an agreed price which includes interest for the funds borrowed. So maybe today they will receive 96, after 6 months they have to repay 100 rupees. Now next point you have to understand, repo is a money market instrument. That means is it used for short term or long term? So normally repo is used for short term money market instrument up to 1 year, which enables collateralized short term borrowing and lending through sale or purchase operation in the debt instrument. So the purpose of repo is that it will help the bank to raise short term funds by using their debt security as collateral. Even RBI can use repo rate to indicate what is the interest rate which the banks have to pay to RBI. Repo rate is an important instrument of monetary policy now. If they charge higher interest rate, it means interest rate in general have increased. Banks will charge higher interest rate to their clients. If RBI reduces the repo rate, bank will also charge lower interest rate to their clients. So increase in repo rate, what will be the effect on money supply? Money supply will decrease because borrowing will become expensive. And decrease in repo rate means money supply will increase because borrowing will become cheaper. Then accordingly it will affect the employment, output, growth, okay, etc. Reverse repo is an instrument through which RBI borrows from commercial bank by giving them security. So in reverse repo, what will happen? RBI will sell security and repurchase it at a later date. Suppose RBI wants to reduce the liquidity in the banking system, then it will undergo reverse repo. RBI will sell and RBI will receive funds. So RBI will remove the liquidity from the banking system. Okay, and later on it will resell them. So reverse repo is defined as an instrument for lending funds by purchasing security with an agreement to resell the security on a mutually agreed future date at an agreed price, which includes interest for the funds lent. So in case of reverse repo, RBI purchases the security and sells them at a later date. In repo, bank sells security with an agreement to repurchase it at a later date. And in case of reverse repo, RBI purchases the security, RBI sells the security and purchases at a later date. Which rate will be higher? Think and answer. Which rate will be higher? Repo rate or reverse repo rate? Repo rate is the rate which RBI charges to the bank. Reverse repo rate is the rate which RBI gives to the bank. Yes or no? So of course RBI will give a lower interest rate and RBI will charge a higher interest rate. It's like a bank. Like when you borrow from the bank, you charge high rate of interest. But when you deposit, the bank gives you a lower interest rate. Okay, so repo rate will be higher. Now in your notebook, you have to write a small note. There is a query by a student. Come on. Is it compulsory for the bank? Repo is their choice because if they need funds, they have to go to RBI. Reverse repo, RBI sometimes issues instructions that we are selling the government securities. You have to follow. That is boss. Your boss says come on Sunday. So what do? They say no, I will not come. You can give me the transfer. Yes or no? No, you can't say that. So I have made a comparison chart. Please write down in the notebook because here we don't have enough space. Because this I am assuming a 4-mark question they will ask you. Repo versus reverse repo. Right hand side 2 columns. Repo, reverse repo. First write down meaning. So this is like a complete summary. Instrument for borrowing funds. Instruments for borrowing funds. By selling security. With an agreement to repurchase them on a mutually agreed future date at an agreed price which includes interest for the funds borrowed. Write down reverse repo. Instrument for lending funds instrument for lending funds by purchasing securities with an agreement to resell them on a mutually agreed future date at an agreed price which includes interest for the funds lent. First point is clear. It's the definition which we discussed. In first case, bank will sell, RBI will purchase. In reverse repo, bank will purchase, RBI will sell. Point number 2, process. Repo operation takes place when other banks borrow money from RBI, by giving securities to the RBI. The diagram which you have drawn is for repo. Reverse repo operation takes place when RBI borrows money from banks by giving them securities. Third point, right? Impact. Impact, right? Repo operations inject liquidity into the system. Repo operation injects liquidity into the system. And reverse repo, right? This operation absorbs the liquidity in the system. Point number 4, interest. Interest, write down. Interest rate charged by RBI for this transaction is called the repo rate. Higher than reverse repo rate. Right here, higher than reverse repo rate. Then right here, interest rate paid by the RBI for such transaction is called reverse repo rate. Interest rate paid by RBI for such transaction is called reverse repo rate. Less than repo rate. Then next point, right? Presently, repo rate is 6.25%. Reverse repo rate is 6%. And then same instruction that you have to check these rates before you go to the exam. Okay. So it is around 6.25% right now. Noted? Write properly. This can be a question in different forms. Write a note on repo. Write a note on reverse repo. Compare repo versus reverse repo. Or they can give some MCQ on this. True false on this. The true false can be repo rate is lower than reverse repo rate. True or false? Repo rate is lower than reverse repo rate. False. Okay. Fill in the blanks. The current repo rate is dash. So you have to write 6.25%. Noted? Now come to next borrowing facility which RBI makes available to the banks. So margin standing facility announced by RBI in its monetary policy 2011-12 refers to the facility under which scheduled commercial bank can borrow additional amount of overnight money. Suppose commercial bank is in emergency, they need more money to borrow, so then which window they can approach? MSF window they can approach. Okay, so here the funds will be available overnight from the central bank over and above what is available to them through the liquidity adjustment facility up to a limit at a penal rate of interest. So quickly guess, MSF rate is higher than LAF rate, yes or no? So if repo rate was 6.25%, this would be little higher than 6.25% because here the funds are made in an emergency like situation. The minimum amount which can be accessed or accessed through MSF is 1 crore, and then after that in multiples of rupees 1 crore. You can't go to RBI for borrowing 50,000 rupees, okay? So how much is the minimum borrowing? 1 crore. Thereafter multiples of 1 crore means then 2 or 3 crore or 4 crore. The MSF would be the last resort for the banks once they exhaust all borrowing options, including the liquidity adjustment facility on which the rates are lower compared to MSF. This question is also asked in the exam sometimes. In some MCQs I have seen that MSF rate is lower than repo rate. False. Repo rate is lower than MSF rate. True. Because MSF rate will include penal rate of interest. So a little high rate of interest is charged. This facility is used by the commercial bank when other facilities have been exhausted. First they can borrow whatever they can borrow under LAF. But if LAF facility is fully exhausted, then you apply for MSF facility. One more line right. Point number D, add in your notes. Banks can borrow through MSF. Banks can borrow through MSF on all working days. On all working days except Saturdays from 7 p.m. to 7:30 p.m. in Mumbai. Yes, it is after the normal working hours are over. So that is why they have used additional amount of overnight money from central bank. Because banks have to ensure that they have sufficient funds to meet the commitments. So if they are running short, then they can tap the margin standing facility window of RBI by approaching at evening 7 to 7:30 in the Mumbai office. Now, question answer for you. Question is also printed. Good news. A facility under which scheduled commercial bank can borrow additional amount of overnight money from the RBI by dipping into their SLR. It is called, just now you have read, can borrow additional amount of overnight money. It is called repo rate, reverse repo rate, bank rate, margin standing facility, or liquidity adjustment facility? You have read just above paragraph. So the answer is D. Tick tick. Margin standing facility. Okay. So this way the questions can be drafted in the exam. Each line becomes important. Come to next heading, market stabilization scheme. In case bank is in an emergency, money from SLR. They have to maintain their SLR. So they will try other options also. If all other options are exhausted, then they will approach this margin standing facility. Okay. They will do that. Why? They will pay unnecessary high interest rate. So that is what finance management is all about, balancing different objectives. And in case of bank, it is a big challenge because RBI says you have to maintain this ratio, etc. And at the same time, they have to meet the commitments of their client also. So that is why this overnight window is given. If nothing works out, you can approach RBI. Come to next paragraph 5. Market Stabilization Scheme, MSS. Previous was Liquidity Adjustment Facility, LAF, Margin Standing Facility, MSF, and now it is Market Stabilization Scheme. Under this scheme, the Government of India borrows from RBI and issues treasury bills or dated security for absorbing excess liquidity from the market arising from large capital inflows. Okay. So here the Government of India is borrowing from RBI. So what will happen? It will reduce the excess liquidity in the system because RBI will have to give funds to the government. It was introduced in 2004, April 2004. Government security issued under MSS are used to absorb rupee liquidity created by capital flows of an enduring nature. So if there is lot of cash flow in the market, government knows that this might cause inflation, so that excess liquidity is absorbed through MSS scheme. It will sell to RBI. Of course, RBI will sell it to the commercial banks and they will try to remove the excess liquidity. The proceeds under MSS were parked in a separate deposit account maintained by the government with the RBI. Now next paragraph, tick mark, write a heading there, bank rate. Did I give you these 2-3 extra lines in your note? I think you have to write. These 3 lines you write there. I have kept some space for you. So 3 points write down there. MSS was introduced in April 2004. MSS was introduced in April 2004. Next write down government security issued under MSS. Government securities issued under MSS are used to absorb rupee liquidity created by capital flows of an enduring nature. And the last point D, write down the proceeds under MSS. The proceeds under MSS were parked in a separate deposit account maintained by the government with RBI. So these are the three additional information about market stabilization scheme, because I have seen one question in one paper, which of the following is true about MSS. So I am going to take that problem also printed below. Now next is point number B, C, D in your notes about bank rates. This word bank rate you might have heard in your 11th standard economics probably. Do you remember? Rate at which bank lends to commercial bank. But this concept of bank rate is now outdated and it is substituted by repo rate. So now with the introduction of LAF, that is repo and reverse repo mechanism, bank rate has become dormant as an instrument of monetary policy. Point number B. B, C, D, you give the heading bank rate on the left side. Bank rate as an instrument of monetary policy has become dormant because instead of bank rate now our repo rate is used. Bank rate has been aligned to marginal standing facility. So now the bank rate is as good as marginal standing facility rate. And therefore as and when MSF rate changes alongside policy repo rate changes, the bank rate also changes automatically. So if the repo rate change, MSF rate will change, and as the MSF rate will change, the bank rate will also change. MSF rate is slightly higher than repo rate and bank rate is slightly higher than MSF rate. Now bank rate is normally not used, but at one place bank rate is used. At which place the bank rate is used? When the RBI has to calculate penalty on default in the maintenance of CRR and SLR. So if you don't maintain CRR and SLR, the penalty will be levied by applying the bank rate. The bank rate is used for calculating penalty on default in the maintenance of CRR and SLR. Otherwise, bank rate, which was a very important instrument of monetary policy, has become dormant. What is dormant? Not active. Like most of you in the class, in the early morning batches. Okay, you are dormant. No, sleeping. Okay. One person is saying CS students are proactive. I agree. Solve this MCQ printed in your book also. Which of the following statements are correct about market stabilization scheme? Just now you have read on the same page. It was introduced in 2004. It's an agreement between Government of India and RBI to issue government securities. The government security issued under MSS are used to absorb rupee liquidity created by capital flows of an enduring nature. The proceeds under MSS were parked in a separate deposit account maintained by the government with the RBI. And option E, all of these. Sure, final, lock. Answer E. Okay. Now next is a concept of open market operation. Have you heard in your lifetime open market operation? If you have studied that RBI chapter in economics classes, you will remember it is a method through which RBI controls money supply. They will sell government security, absorb excess liquidity, or they will purchase government security and infuse the additional liquidity into the system. Okay, so that is open market operation is basically a tactic employed by RBI to control the liquidity in the economic system. When RBI feels there is an excess liquidity in the market, the question will be, if there is excess liquidity in the market, what should RBI do in the open market operation mechanism? Then it will sell government security. If it will sell means banks will have to buy. So bank will have to give funds to RBI. So it will reduce the money supply in the economy. And when there is a tight liquidity situation, what RBI will do? It will purchase government security and it will give funds to the banks. So more money will be available with the banks, means more amount they can lend. Now, some MCQs for you on RBI and monetary policy. Question number 3. What would be the impact on the cash reserve of the commercial bank if RBI conducts the sale of securities? Decrease, increase, either increase or decrease, remain constant, no connection. A, B, C, D, E. A. Yes, right answer. But only if you have understood the concept you can answer. Otherwise, these are not easy questions. It requires a lot of logical understanding what is happening in the books of bank. They are buying security, so they are giving cash to RBI. So cash reserve will decrease. Which of the following is or are the quantitative instrument of RBI? CRR, bank rate policy, SLR, all of these. None of these. D. Sure. D. One more I will ask. Multiple choice type question. Is it right? The primary source of money supply in all countries is RBI, Central Bank of the country, Bank of England, or Federal Reserve? Central Bank, because RBI is only for India. In all countries means it has to be a general answer. So the answer is Central Bank. Tick mark, Central Bank. At the end, if there is a multiple choice question. Okay. So you will tick mark Central Bank of the country. Okay, try the next question there. Banks in the country are required to maintain deposit with the central bank. Option A, to provide the necessary reserve for the functioning of the central bank, to meet the demand for money by the banking system, to meet the central bank prescribed reserve requirement. Okay. And D, settlement obligation. And E, to meet the money needs for the day-to-day working of the commercial bank. So who said A? Are banks required to deposit money so that central bank can function? Answer is C, to meet the central bank prescribed reserve requirement. This word you cancel, and to meet. Maybe some word is missing. And to meet the settlement obligation. So you remove this D here. Okay, try next one. This time you will answer, I will not answer. Which of the following is the function of monetary policy? Which of the following is the function of monetary policy? Read and answer. Regulate the exchange rate and keep it stable. Regulate the movement of credit to the corporate sector. Regulate the level of production and prices. And regulate the availability, cost, and use of money and credit. In case if you find more than one answer is possible, choose the best of the lot, because probably they will check it using computers, probably. Then only one answer you have to choose. So the answer was T. Okay, one more question. Main objective of monetary policy in India is reduce food shortage. Is that the objective of monetary policy? Economic growth with price stability. Overall monetary stability in the banking system. Reduction of poverty and unemployment. A, B. Okay. Economic growth and price stability is the best answer out of this lot. Other answers, even if they may be right partially, but you have to choose one of the two or four only. A contractionary monetary policy. What is contractionary? Means it reduces the money supply. Induced increase in interest rate. That means if you increase the interest rate, what will be the impact? It increases the cost of capital and the real cost of borrowing for firm. It increases the cost of capital and the real cost of borrowing for the firms and the households. Decreases the cost of capital and the real cost of borrowing for firm, has no interest rate effect on firms and household. A is also right, but B is better because B also uses the word and household. So increase in interest rate is going to affect the borrowing cost of household also. Okay, so you tick mark B. These are the questions taken from ICI module only somewhere. Point number 6. During deflation, means there is a recession, what will RBI do? A. RBI reduces the CRR, very good, in order to enable the banks to expand credit and increase the supply of money available in the economy. RBI increases the CRR in order to enable the banks to expand credit and increase the supply of money. RBI reduces the CRR in order to enable the banks to contract credit and increase the supply of money available. RBI reduces CRR but increases SLR in order to enable the banks to contract credit and increase the supply of money available in the economy. A or B? A is the right answer. Because in other case, first this RBI increases CRR is totally wrong, because we are into deflation. We have to make more money available in the hands of public. RBI reduces the CRR, but this second line is wrong. In order to enable the banks to contract credit, bank will also increase credit, and here they have written in reduce CRR but increase SLR. Then the reduction in CRR will be nullified by increase in SLR. And even this line is also wrong. To enable the banks to contract credit, during deflation we have to increase the credit availability. 7 number question. RBI provides financial accommodation to the commercial bank through Repo, reverse repo under MSS, MSF, LAF, SLR. Today you have read this. Which one? LAF. Sure. Final. Lock. C. Right answer. All these are potential questions in your exam. Okay. Solve 8. Dash is a money market instrument which enables collateralized short-term borrowing and lending through sale or purchase operation in debt instrument. Read again and answer. Short term. A or D? Not D. Think about D. Read the definition of repo somewhere in the previous page. Point number 3 in the repo. Repo is a money market instrument which enables collateralized short-term borrowing and lending through sale or repurchase obligation in debt instrument. Is it printed there in bold letters? OMO is not necessarily for short term. OMO can be for long term also. That means Government of India security of say 5-year maturity can be sold under OMO. But repo is for short term borrowing. And then this word collateralized is also used. In OMO there is no collateralized security given. Okay. So 2 reasons you underline why it is right. Repo, collateralized and short term. To sometime 2 answers are very close, but then best answer you have to choose. This line directly taken from institute module. Only what they did, they removed the word repo and they have set a question on that. Taken from some ICI material only here or there. In India, the policy rate refers to, you will hear that policy rate has increased, decreased. What has increased or decreased? Read the problem and tell me what rate changes when the finance minister or RBI says policy rate has changed. The bank rate prescribed by RBI in its half yearly monetary policy statement, CRR and SLR prescribed by RBI in its monetary policy statement, fixed repo rate quoted for sovereign securities in overnight segment of liquidity adjustment facility, and the fixed repo rate quoted for sovereign security in the overnight segment of marginal standing facility. Vote for A. No one. Vote for B. Vote for C. Vote for D. Most votes have gone for B. Read again. Policy rate does not talk about, it does not mean CRR, SLR. Policy rate will always be the interest rate. And which interest rate? Now there are 2 interest rate, LAF rate, MSF rate. So it is the repo rate which the government talks when they say this policy rates have changed. Okay. You may not know because it was not mentioned in the note anywhere. No, but fixed repo rate is written. No? So you have to give importance to this term repo rate, and LAF is mentioned here. So the liquidity adjustment facility rate is the policy rate. Although they have used the word overnight, I will check why they have used, but do not give more importance to this term. Give more importance to repo rate and liquidity adjustment facility. Okay. So what you do, come to your notes, liquidity adjustment facility, and add one sentence there. Add one sentence in liquidity adjustment facility. In India, policy rate refers to fixed repo rate. Fixed repo rate quoted for sovereign securities. Quoted for sovereign securities. In India, policy rate refers to fixed repo rate quoted for sovereign securities in the overnight segment of liquidity adjustment facility. In the overnight segment of liquidity adjustment facility. This also one point about LAF. Done. Okay, I think 2 more MCQs are pending. Question number 10. Reverse repo operation takes place when RBI borrows money from banks by giving them security. Bank borrow from RBI by giving them security. Bank borrow money in the overnight segment of the money market, and RBI borrows money from the central government. A. Because RBI never borrows from central government. Okay. So now you have to make a choice between A, B, C. First is the right answer. RBI borrows money from banks by giving them securities. Okay, now try 11 number. An open market operation is an instrument of monetary policy which involves buying or selling of dash from or to public and banks. So what does government do? What does RBI do when it performs open market operation? It buys or sells bonds and bill of exchange, debenture and share, government security, none of these. Which instrument is bought and sold under OMO? Government security? Let me check. Yes, you are right. Question number 12 is not a MCQ. Here it is a case, and you have to answer what will be the nature of the monetary policy undertaken by the RBI in the following. It's like a small case study. RBI is suppose going to increase repo rate by 50 basis point. Will it increase the money supply or decrease the money supply? Decrease. Reduce the cash reserve ratio. Increase. So this is called contractionary monetary policy. This is called expansionary monetary policy. Whatever you can write in the exam. Increase. I will explain. I will write. Don't wait. First discuss. Increase the supply of currency and coin. Increase in money supply means expansionary policy. Terminate the marginal standing facility. Banks will not be allowed to borrow under marginal standing facility. Decrease in money supply. Increase the interest rate chargeable by commercial bank. Decrease the money supply. Sell security in the open market operation. Decrease the money supply. Initiate reverse repo operation. Decrease the money supply. Change in the SLR. According to change, it will increase or decrease the money supply. So they should have written increase or decrease. So anyway, you will write the answer like this. Right on the right side, some space is there. Increases repo rate by 50 basis point. I'm just giving an example how the case study can be asked. And this is going to test the knowledge of a student. You will not get the answer directly in the study material. Directly you will not get. You have to read the whole thing, understand, and then write. Instead of that, you prepare in advance only. You can quickly answer. Searching for such questions will take a lot of time. So first one is contractionary monetary policy. Second, expansionary monetary policy. Third is also expansionary monetary policy. Fourth, fifth, sixth, contractionary monetary policy. G, initiates reverse repo transaction. Absorbs the liquidity in the system, or you can write contractionary monetary policy. You can use this sentence or you can use this sentence. Changes in SLR influences the availability of resources in the banking system for lending. Is it right? All of you have written? So write fast. Now the next paragraph number 2 is about US Federal Reserve. About the US Federal Reserve System. Good news. Not a break. Not a holiday. It is same like RBI. Okay. So you don't have to struggle much here because almost all central banks have broadly similar functions. But Federal Reserve is very important because the rate announced by Federal Reserve not only affect USA, it also affects other markets. Because then the money supply may increase or decrease in one country and other countries. Okay, we'll discuss that point also. So Federal Reserve System is the central bank of the US. That's very easy. By now you must be knowing it. In the first chapter also we had some discussion on Federal Reserve. It performs 5 general functions to promote the effective operation of the US economy and more generally the public interest. So basically the question in the exam would be, what are the 5 functions of Federal Reserve System. So 1, 2, 3, 4, 5. General question can be what are the functions of Federal Reserve, or 5 specific functions which they have mentioned. So first is it conduct the nation's monetary policy, like what RBI does. So it is the entity responsible for designing the monetary policy, like in India RBI, to promote the maximum employment. In USA the priority is given to employment, more priority is given to employment compared to inflation, because inflation is already very low there, and employment is a very important election issue in America, right? One of the reasons why some recent presidents have been elected is that they promised. What did they promise? Make America great again, American jobs with American. Okay. So the reason is that these two countries are also very different. India and America are different countries. Priorities may be different. The point of difference is that in USA more importance is given to maximum employment, stable prices and moderate long-term interest rate in the US economy. Second function is to promote the stability of the financial system, because US is an economy. If something goes wrong there, it may affect other economies also. So there the Federal Reserve is very powerful, more powerful than any other central bank. It is said that the post of the governor of Federal Reserve or chairman of Federal Reserve is just next to the president in USA in hierarchy as far as power is concerned. So promote the stability of financial system and seeks to minimize and contain any systemic risk through active monetary and engagement in the US and abroad. So you will say financial system stability is the second objective. Third objective is promote the safety and soundness of individual financial institutions. In USA, the banks, investment banks, mutual funds, pension funds, insurance companies are very big institutions. Individually, they are very big institutions. So even they need to be protected. If something goes wrong in one big bank, it may affect the whole US economy, probably. Is it right? So they have to continuously monitor their impact on the financial system as a whole. In 2008, Lehman Brothers, one big investment banking company, had filed for bankruptcy, and then it created a chain reaction. More and more investment banks, insurance company, they came into trouble, and then RBI, US government had to bail them out. US government had to bail them out. That means they have to fund them. But then US is a capitalist economy. It is not a socialist economy where government will bail out the private sector. But to protect US economy and world economy, the government had to do that. Next is foster payment and settlement system safety and efficiency through services to the banking industry and US government that facilitates US dollar transactions and payment. So payment and settlement, safety and efficiency. US dollar is traded in all countries. So they have to ensure that there is a smooth payment and settlement of US dollar. You can go to any country and carry US dollar and you will not be into problem as far as currency is concerned, because dollar is almost accepted in any country. Okay. So that is why US is so popular and powerful. And fifth function is promote consumer protection and community development through consumer focused supervision and examination, research and analysis of emerging consumer issues and trend, community economic development activities, and administration of consumer laws and regulations. So these are the points which you don't have to remember, but remember that these are functions this Fed performs, so that if there is a question you can copy it from here. Okay, but understanding is important that functions are broader than our RBI. What are the Fed policy tools? So first paragraph I have written similar to RBI, open market operations, which I am not going to explain. It is same like RBI. If they want to reduce the money supply, sell the government security. If they want to increase the money supply, purchase the government security. Okay. Second is the discount rate, which is similar to our repo rate. The discount rate means the interest rate charged to commercial bank and other depository institutions on loans they receive from their regional Federal Reserve Bank's lending facility. Same like our repo rate, that is the discount window, and whenever this rate is changed, it affects the global economy. The Federal Bank offers 3 discount window programs to depository institutions. Depository means banks only, large banks. Okay, like in India we had seen, we had repo rate, then the margin standing facility. Here also we have primary credit rate, secondary credit rate and seasonal credit rate. Now we'll see each of them. Each has its own interest rate. All discount window loans are fully secured. So first you have to give government security, then this Federal Reserve will give you the loan. Now what happens in the primary credit program? Under primary credit program, loans are extended for a very short term. This all you will keep in mind for true, false, fill in the blanks, MCQ. Under primary credit program, the loan is given for a very short period, usually overnight, to depository institutions in generally sound financial conditions. Short-term loan to banks and depository, okay, and those which have sound financial condition. No risk. Depository institutions that are not eligible for primary credit, like they may not meet those sound financial condition parameters, then they will knock for secondary credit, which is for short-term liquidity needs or to resolve severe financial difficulties. That is called secondary program. And the third is seasonal credit. Seasonal credit is extended to relatively small depository institutions that have recurring intra-year fluctuation in funding needs, such as banks in agricultural or seasonal resort communities. So here the funding is given season wise, because sometimes there is a huge demand and sometimes there is no demand. Like agricultural sector have huge demand on certain seasons only, at the time of say sowing and harvesting. Similarly, resorts have more people flocking in during Christmas, New Year, January. So that time there is a demand. So seasonal credit is extended to such institutions which have recurring intra-year fluctuation in funding needs. Now we will take a break.